Hello everyone, welcome back to our YouTube channel. I'm Divyansh from the product team at Wint. Meet Ramesh, a computer science engineer who graduated in 2019 and got a coveted job with an MNC even before getting his degree in hand. But like many other young professionals in their early 20s, he did not think of saving up until his father fell ill and needed funds. While applying for a high interest personal loan, Ramesh thought how good it would have been if he had some personal savings. Now this prompted him to look at investment options available for Indians. Since Ramesh was a risk-averse investor, investing in stocks was out of the question. He wanted to invest in debt and narrowed down to two options: fixed deposits and bonds. But which is better of the two? In the following sections of this video, we will be elaborating the differences between fixed deposits and bonds. So stay tuned because in the next few minutes are going to give you some incredible tips to save up for the golden future. Let's look at the similarities between them. Both bonds and FDs are fixed income instruments that guarantee the rate of return at time of maturity. The financial or investment institution declares the rate of return at the time of investment. Before investing, the investor clearly knows when they will be getting the investment amount and at what interest. The eligibility criteria of investing in bonds is same as an FD. You must be a citizen of India and your age must be above 21. During opening of an account, an investor needs to provide their PAN card, Aadhaar card and bank account statements apart from their investment amount. Moreover, both the financial instruments are well suited for risk-averse investors. Now that you know the similarities between the two, let's understand the differences between bonds and FDs. Broadly speaking, there are 5 key differences between bonds and FDs. They can be classified as the usage of funds, risk, return, liquidity, availability and investment process. Let's understand each in detail, starting with the usage of funds. When you invest your amount in an FD, the bank or the institution promises to pay you interest on the amount that you've invested. The bank gives out your money as loans to eligible people who approach them. Let's say you get 5% interest against the FD you've opened at a bank. The bank may charge their borrowers at a rate of 9%. The remaining 4% is the bank's income. In contrast, bonds are issued by private entities or government bodies looking to raise funds for their projects. Let's say XYZ Corporation has to execute a flyover project and they need funds. Now, instead of raising equity or getting a high interest loan, they issue bonds. Also, raising equity means losing ownership of the company. Hence, bonds are a cost-effective and sensible way to raise funds for a fixed duration of time. Now, let's speak about some risks. Both bonds and FDs carry some form of risk. Let's say you open up an FD with some scheduled commercial bank in India, your investment is secured up to a sum of 5 lakh rupees. Bonds on the other hand are issued by private entities or government bodies. Investors often look at the rating of the bond to understand the risks involved. Before rating them, credit rating agencies like ICRA or CRISIL rate these entities based on their financial worth and creditworthiness. Irrespective of the rating, the investors should always do their own assessment on the issuer of the bond before they start investing. A quick fact check about bonds and FDs reveals that bond returns are usually 2 to 3% higher. However, bond returns are not always guaranteed. But to a great extent, the bond prices are heavily linked to the economy's interest rate. Let's say if the Reserve Bank of India increases its interest rate, then the bond prices will fall and vice versa. Both bonds and FDs are illiquid investment options, although FDs are slightly more liquid than bonds. In India, there is no secondary market for bonds, so selling non-government bonds is quite hard. In contrast, you can close an FD by submitting an FD certificate to the financial institution before maturity. Banks usually charge 2 to 3% as a pre-closure penalty. Both bonds and FDs are highly available. If you want to open an FD, you can approach a bank, an NBFC or a housing finance company offering such products. Several online portals allow you to invest in bonds. Alternatively, you can open a demat and trading account and look for open bonds and invest online. So by now it's quite clear. Bonds provide higher risks than FDs, but they can be considered riskier as well. So do you feel confused? If yes, you're not alone. Millions of investors ask the same question to their financial advisors every year. Fortunately, one financial instrument gives you comparatively high returns and has some risk mitigants in place. Now let me introduce you to covered bonds, the perfect combination of high-risk bonds and low-risk FDs. Covered bonds are a relatively new form of financial instrument which helps investors to mitigate common risks associated with other corporate bonds. Institutions issue these bankruptcy-protected bonds with collateral-backed loans. Now let's try and understand this in a little bit more detail by taking an example. Let's consider Mr. XYZ, who owns a vehicle financing company which gives out loans to vehicle buyers and keeps their vehicle papers as collateral. Now one fine day, Mr. XYZ realizes that his capital is barely enough to disburse more money to vehicle borrowers. So the right to collect money from these vehicle owners is transferred to a trustee. Now, Mr. XYZ's financial company issues a covered bond to investors against the collateral which was deposited with the trust. However, it must be noted that there is no physical transfer of the assets in this process. Now, in a scenario where Mr. XYZ's company is unable to pay the interest and the principal amount to the investors, the debenture trustees would utilize the repayment coming from the vehicle loans to repay back to the investors. Covered bonds, if invested via a platform like Wint, provides return in the range of 9 to 11%. If you want to know more about these assets, please send us an email at hello@wintwell.com. You can also hit us up at our WhatsApp number. Thank you and happy investing.